Hi, this is Andrew Zizas, President and CEO of New Jersey-based Real Estate Strategies Corporation, coming to you today as part of the Financial Executive Thought Leader Series here at the CFO Studio. Please visit us at www.cfostudio.com. We're here today with financial executive Andrew Savadelis. Andrew's depth of experience ranges from biotechnology to technology companies with an orientation toward turnaround and commercialization stage companies. Andrew, thanks for being here today.
Andy, it's a pleasure. Thank you.
I appreciate you joining us on the CFO Studio. There's a lot of great stuff going on in the world today, a lot of exciting dynamics in the finance world, and you and I know each other for a long time, and I know you're one who's not shy about his opinions, and looking forward to hearing your thoughts and guidance that you'll offer to our viewers.
My pleasure.
Well, why don't we jump right in. Let's talk about bank financing, first of all. Both traditional bank financing and government financing. The companies that you've been involved with both. Talk to me a little bit about the difference between the two and the pros and cons and the good, the bad, and the ugly.
Sure. Well, it greatly depends on what stage company you have. So, for example, a turnaround situation company that has revenues actually has a shot with traditional bank financing. The banks, it's the type of thing where the bank is there when you actually don't need them. But in a turnaround situation, since you probably have some revenues, what you have to convince the bank of is that you're on the path to profitability and you have revenues to loan against, for example, receivable financing. It's still very difficult. And the main reason actually why you might want to do that in that type of situation is it gives you credibility that a major bank has come in and done their due diligence and given you credibility as a company going forward, that you're not going to go under, you're not going to go Chapter 11. I had a case where a turnaround in a biotech company, we were burning $60 million a year on $70 million in revenue, market cap of less than $20 million. Everybody thought the company was going under. Well, within the first quarter, we had sold off a business that was burning $5 million and started the company on path towards profitability, or at least getting there. We then obtained the bank financing. We basically obtained a $10 million loan, revolver loan. And what that told the market was, okay, here's a bank, they've done their homework, they believe that this company has a future going forward. At the end of the story, basically less than a year later, we had turned the company around, gotten the burn down to less than $2 million, and the market cap up to over $140 million. And part of that was because we had the credibility from the bank. Now, let's go to government financing. I've been working with a company recently where we're building a high-tech chemical company. It's a green energy company, and there's two things that the government is looking for. In this case, it's a Department of Energy loan guarantee program. It's a $10 billion program.
$10 billion? $10
billion program. Wow. We won a $250 million loan guarantee that we are now in due diligence with.
Nice job.
It's been very interesting, to say the least. But here's what the government is looking for. They act as a bank in terms of making sure that everything is in place. So they're doing their due diligence and whatnot, both on the technology and the wherewithal of the company and our markets, although we don't have revenue yet. Okay. But they're still willing to lend to us because why? It falls within a major program within the government, green energy. This is a company that's going to be making products for the solar industry, number one. And number two, and probably more importantly, we're creating jobs. And in this environment, the government wants companies who's creating jobs. So they're willing to work with a company that doesn't have revenues but has a promise of revenues, but they want to make sure that our technology works. So there's been a lot of due diligence there, and that we're creating jobs, which we have been doing.
So they're acting kind of with the mentality of a bank, but they have other objectives beyond that of just a mere bank.
They have a policy agenda, and we have fallen within that major policy agenda. So we got beyond that perspective, and that actually took a lot of political wrangling. We actually got Governor Rendell, both of our U.S. senators, to write letters and actually make Governor Rendell actually made a phone call to DOE Secretary Chu on our behalf.
Wow.
So that helped us win that DOE loan guarantee, at least to get into the program.
Sounds like you had credibility even before you got the loan.
Well, it took a lot. There was a lot of behind the scenes going on with the company, even before I got there, and then when I got there as well. So that's probably the main difference, is that the government will still wants their money back.
Right.
And there's a lot of issues there, but they put that within the policy, within their major policies of what the government wants.
So they've got a multiple agenda.
That's correct.
So now let's stay on financing for a moment, but let's take it to a different level. Let's talk about venture capital versus strategic investors. Talk to me about the drivers that both the VCs versus the strategic investors look at when they're considering loaning or becoming involved with an investment.
Sure. No, it's a great question because there are differences in how each approaches it. They basically, if you're in a company, particularly this is more oriented towards companies that are in the commercialization stage, for example.
Okay. As compared to a turnaround.
As compared to a turnaround, or even, let's say, a startup. The VCs basically look at the company, they look at two things. First and foremost in their mind is it a management team that they can believe in? So you have to have both a CEO, a CFO, an ops guy, or tech that they actually believe can get the job done and move the company forward.
So it's not just a product or an idea, and it's not just a company, it's the team.
That's actually almost secondary to a VC. They obviously want, and different VCs have different perspectives.
Sure.
There's VCs who do biotechs, there's VCs who do techs, some do both. With the product, they want to know that there's a product there or a potential product and that there's a market. But that's secondary to the team being in place. That's number one. Okay. And then the second part is that their end game is different. Okay, the part of this is that they want, within 3 to 5 years, they want to know that there's an exit strategy, and usually that's an IPO or selling of the company of some sort. Now let's contrast that to a strategic investor. A strategic investor has a little different perspective. They're probably more after the technology and the markets and care less about the management team. And in some cases, they'll end up replacing part of the management team to get to their end game. Their end game is less likely to be to sell the company or an IPO the company, assuming you're private. And their end game is to either try and negotiate and get as much of the IP or a industrial agreement, or both, out of the company, and that way they get either supply, it could be anything, it could be supply agreements, all sorts of things that kind of get in that they can extract from the company and give them a competitive advantage against their competitors. So they're putting an equity stake in, so they're hoping that you're going to do well on the equity side as well as a business, but they're also extracting other things that a VC would not necessarily be interested in.
And it sounds like the strategic investor is probably in it for a longer term than the VC typically.
That's right. Well, there's a couple issues there. One is, although in this environment, I've actually seen it a little bit differently, where both VCs usually want more of the business. They want more of the equity. In this environment, I've seen, particularly if you're in a company that needs the cash, and this is always the issue, if you're cash poor, you have it's much harder to bargain with either a VC or a strategic.
Sure.
Usually a strategic has been willing to come in for less of an equity stake, either in valuation or in terms of actual percentage of the company. I'm seeing less of that. I'm seeing them being very aggressive.
Really?
As a matter of fact, we recently had to deal with a bit of a down round, even though the company was pretty well capitalized from other current investors. I mean, we had over $100 million of equity in the business, and we brought a strategic in who basically beat us up pretty well.
Wow.
But in the long run, if you need the cash and you want to grow the business, you have to look beyond the current issue as to what's your long-term strategy. And in this case is a combination of you need the cash, in our case, to complete the high-tech chemical plant and get it up and running. We were in hot testing and whatnot. And their clout to help us in the marketplace to a certain extent. What they wanted was the technology, because our technology was unique and would allow us to produce at about a third less cost than anybody else in the world. So they wanted the IP, they wanted the know-how and the marketability to go and basically replicate plants possibly in the future, of which we get a piece.
Wow.
But those negotiations ended up being over 7 months.
Wow. So there's an awful lot for us to think about when we're doing financing, from strategic investors to VCs to bank or government financing.
Well, and more important, and just as importantly, you have to know what their mindset is, so you know how to approach and position the company to get the best deal.
Wow. Andrew, I want to tell you, we could go on for hours like this. We're about out of time. I wanted to thank you very much. Some great insight into financing. We really appreciate your being here at the CFO Studio. And I want to thank you for watching us at the CFO Studio. This is Andrew Zizas saying have a great day.